right, guys. Well, we are hitting that 5:32, 5:33 mark, which is always when I like to get things started. Give people a second to sign in. Thank you all for coming to talk about taxes. As I mentioned, this wasn't going to be the day after tax day, but here we are. I'm Lindsay Benton. I own Live.Laugh.Denver real estate group here in Denver, City Park specifically. I will be only facilitating tonight. As I was mentioning, I have the worst, probably tax prepping and yeah, just all of it exhausts me. Honestly, it's pathetic. But that's why we have professionals. So hopefully, I'm looking to see if Steve is on yet.
Lindsay,
there you are.
I am on. Can you hear me?
Yes, I can hear you. Okay, guys, so I'm going to introduce Steve real quick. He is calling in from First American Exchange, and he is a 1031 genius. So that said, Steve has 15 minutes for us before he has to hop off for a family obligation, which we totally respect. So I'm going to let you get going to tell us everything we need to know, and we'll go from there.
Thank you so much. Now, let me make sure I'm delivering on what you need to know or what you're looking for. I understand you're looking for kind of an update on what's going on in DC as far as Section 1031 and maybe a little bit more than that.
Yeah, I would say an update, but also just a general kind of history of it all. I know that right now we're going through some potential updates, but that's kind of been what 1031 exchanges do, right?
Yeah, there's no doubt about it. It's to give you a little bit of context, there's a current proposal, I think everyone knows, for a tax bill that Speaker Pelosi, a tax reform bill that Speaker Pelosi would like to have a vote on before July 4th. And part of that discussion, there's a great many things in that discussion the discussion's going on now related to what's going to be in the final bill. So one of the major proposals in the bill is to limit 1031 exchanges to $500,000 worth of gain. Now, we don't know a lot about that limitation, meaning, does it mean it's a limit on per exchange per year, or is it per taxpayer per year? We don't know. So we're trying to figure that out. But what I can tell you is this. Going back as far as, let's say, 2016 and 2017, and even further beyond that, Section 1031 is a popular subject when it comes to raising revenue at the congressional level. They tend to look at 1031. It comes up every few years as a target. And most recently, in the run-up to the Tax Cuts and Jobs Act, which became effective in 2018, there was talk about eliminating Section 1031. Well, my industry, the Federation of Exchange Accommodators, and what's called the Real Estate Roundtable, were able to jump in over 2016 and 2017 and provide congressional legislators, especially those in the powerful tax writing committees, with an education as why 1031 is important, especially in the real estate industry, in the community, both on the residential side and the commercial side. Now, the feedback, even though we were very successful in preserving Section 1031 for real estate, the feedback from the tax writing committees, either on the House side or the Senate side, was this. We were receiving from the Democrat side that Section 1031 is for the wealthy. They're getting away with it. They're selling yachts and mansions and trading into other things that they're passing on to their heirs and avoiding tax. On the Republican side, we were getting that, why do we need qualified intermediaries? We'll just allow people that sell real estate and then buy replacement real estate to fully expense that replacement real estate, thereby potentially eliminating their gain. Well, that was pretty negative feedback back then, and we had an uphill battle, but we were successful. What's been going on since that Tax Cuts and Jobs Act, since the formation and the approval of that bill, was a lot more education. So both my industry and powerful members of the Real Estate Roundtable, like NAR, NAOP, and others, have been providing ongoing education across legislators. So within the tax writing committees, like the House Ways and Means Committee and the Senate Finance Committee, over the past 5 years. So what's happening now? What's happening now is the feedback we're getting from legislators, both within and outside of those tax writing committees, is I actually do 1031 exchanges. This is actual feedback from Congress members. I do 1031 exchanges. I think they're valuable. And in particular, as they're drafting the bill right now, most recently, the House Ways and the Ways and Means Committee had a subcommittee meeting 2 days ago. And in that meeting, a ranking member said we should not be looking at 1031. They're particularly harmful to eliminate right now. Others are saying that we should, the same thing. We should look at other tax initiatives. So the education is ongoing. It's proving to be successful in getting members not only to understand their importance, especially in a fragile economy, a fragile commercial real estate economy, but they're also starting to use it and appreciate it. So even though they're drafting that law now, and that proposal to limit 1031 exchanges exists, I'm feeling pretty optimistic about its chances. The feedback is so much different now than it was in the run-up to the Tax Cuts and Jobs Act. That's currently where we stand on 1031s. We're waiting to see. We're proactively continuing to educate legislators, but we never know for sure what's going to end up in that draft bill until the draft bill is presented. That's very narrowly focused on the update on Section 1031. Does anyone have any questions? And we can expand the conversation a little bit.
When you talk about the impact on the economy, I've heard some numbers associated with this because it goes beyond just who's paying taxes or not paying taxes on proceeds. It then leads to development, et cetera. So what number are we putting on that?
Oh, there's a number of studies that talk about that. And I'd have to dust off my numbers, but what I can tell you is that two things: that 1031 exchanges have a particular place of importance when it comes to the real estate market, is that they remove friction. So the decision to sell isn't impeded by tax ramifications, meaning the potential tax liability. Other industries, other assets that are sold and purchased on a regular basis have very readily accessible market platforms like stocks and bonds, easy to sell and easy to buy. But when it comes to real estate, it's more than just a qualified intermediary industry. Every time there's a 1031 exchange, accountants, attorneys, contractors, escrow agents, real estate brokers, agents of all sorts and types are employed and engaged. Now, I can't recall exactly, but I think that the impact over a 4-year period is about $88 billion. But what I can do is take a look at those numbers and follow up after this discussion with everybody to make sure I have the right numbers. I just don't have them handy. You have to forgive me. I'm sitting in a car outside of a school right now.
Yeah, no worries. I didn't mean to put you on the spot like that, but I think that the ripple effect is something to definitely note. 88 billion, dang. We'll follow up with that number for sure. And thanks for taking a stab at it while you sit to head inside.
Hey, Steve, I have a question for you, actually.
Go ahead.
Do you think that the loss of a 1031 exchange for tax purposes is more detrimental to real estate investment than the loss of a step up in basis that's also been proposed from the current administration?
Yeah, that's a great question. I don't know for sure. I can tell you that the loss of 1031 would have an immediate impact on the selling and buying of real estate. The long-term effects because of the step up in basis, I don't know. But it would immediately slow things down. I think immediately it would, depending on whether or not the law is retroactive. If it's not retroactive, you'll have a rush to sell and shelter those gains. If it is, then things would lock up immediately. So I think there'd be a considerable slowdown immediately. Beyond that, it's interesting to note that somewhere around nearly 90%, somewhere around 87% of all properties that have been acquired in a 1031 exchange, or all exchangers, all investors that participate in 1031 exchanges, almost 90% of them, in their final acquisition, they end up disposing of that final replacement property in a taxable transaction. So the idea that 1031 exchanges result in exchange, and die, step up in basis is not true. The reality is that most of the time, the vast majority of the time, investors end up selling that replacement property, presumably appreciated investment property, and paying tax on that to the Fed and at the Fed and state level. So most exchangers don't just continue to exchange over their lifetime and then take advantage of step up in basis.
Awesome. One more question for you, because I know you got to run. Do we think that the 1031 exchange, if it were to be taken away or even taken away at the $500,000 level, though we don't know how that even looks, do we think it could negatively affect housing affordability? Yeah. Great question. If with 1031 in place, it allows investors, right, to leverage more of their equity without loss of that investment, that equity, I think it would make it more expensive for investors. There's no doubt about it. If I'm selling investment real estate and I can leverage every dime of that investment, it's been a great investment. It's provided, let's say, an income stream. It's provided deductibility of expenses from the tax perspective. It's been a great investment, but on the way out the door, absent 1031 exchanges, I don't have the ability to maximize that investment at end of life, basically, end of its service to me, which means I have less cash to buy replacement property. Or maybe I just don't buy replacement property, but from an affordability standpoint, it becomes more expensive for me to go and buy replacement real estate. So from an investment perspective, I think it makes it more expensive to acquire replacement property. Thank you so much, Steve. I'm going to kind of speak to that a little bit and tie in the construction defects laws we saw that made it so much more expensive for developers to develop. And then we saw those prices be passed on to potential buyers. And that's how we got our slot homes in Jefferson Park. So I do think that eventually it gets passed on, right? Because you're having to account for the additional taxes you're going to have to pay on said investment. So there's ripple effects everywhere with it. We're all keeping a close eye on it. I know that you need to hop off, and I want you to have a great evening with your family. Thank you so much for taking the time, and we'll be in touch.
Thank you so much. And I'll follow up with those numbers and some links to some studies. So if you have any questions beyond that, I'm happy to have a deeper discussion.
Perfect. Thank you.
All right. Have a great night.
So we'll send all the information he forwards out tomorrow, along with the video, so you can share it with whomever or watch it again. Next up, we have Mike. Mike is a CPA and owns his own. He is a partner in an accounting firm. And I want to we kind of started with our master's level, and then let's back it up a little bit. Do you want to talk at all about the 1031 exchange in general, but then also the basis discussion you guys were having when CPAs talk to each other? It's a different language. It's like when lenders talk to each other.
We nerd out a lot, that's what accountants do. So the 1031, I think that Steve is 100% correct on what that'll do to the real estate market. Eliminating the tax-free rollover of gains into real estate will immediately affect real estate. The step up in basis that we're referring to, if anyone inherits property, real property through will passing through generations, at the date of death of the person who owns it, the beneficiary of that property through will would get a step up in basis to the fair market value of the property at we'll call it the grantor in this scenario. That's probably not the right legal term, but in a normal situation, it's a parent. So a parent owns a house for many, many years, then by their will, it passes to their kids. Their kids at the date of death get a step up in basis to the fair market value of the house when their parent passes, meaning that they can take that property, they would inherit that property at the value it's worth on the real estate market today. so that they can convert that asset to cash without any tax consequences. So eliminating that, which is proposed in tenant, it's not even proposed, it's speculated that that could come through in the current administration's tax plan, would in essence create a generation skipping tax to those who are inheriting property that's been passed through generation. Probably still confused the topic more than I helped, but that's what we refer to in the step.
Can I talk in numbers real quick for everyone?
Mhm.
I'm in real estate, so we keep it very simple. So if parents bought the house for $100,000 and it's worth $500,000 when they die and it passes on to the kids, you'd think the kids would have to pay for the 400, but the step up in basis, which seems like a lot of words, means that they'd only have to pay, it would be worth the 500. So if they kept it for a year and it went to 600, they would only have to pay the capital gains taxes on the 100.
Correct.
Cool.
Or they could turn around and sell it immediately and not have any capital gains, because that's really what's happening.
Yeah,
Exactly.
But now the changes are, and Mike, do you know, because I was asked this question and I think it's just as nebulous as the 1031 exchange conversation at this point, is what's the limit on that? They're talking about not getting rid of it altogether, but limiting it to the first million single, 2 million couple. Is that based on income or is that based on step up value?
I think it's going to be a graduated scale based upon income, but like you said,
Yeah, we don't know yet.
I think there's less talk about the reduction in step up in basis than the eliminating the 1031. So I think the step up in basis, that is probably a lower level tax prerogative than the 1031 is currently. But who knows? No one knows. And they love to pass things after the fact so that you can't really plan for it. So we got to watch that.
sounds like city council. Let's go back to the beginning with this. And Mike, can you speak to what we can write off for our primary homes now? And again, you guys saw the disclaimer, everyone's tax situation is different. So I don't want Mike to have to go through all the different, options of incomes and all that. But in general terms, what can we write off for primary homes now versus what we can write off for investment homes?
Primary residence. Your primary residence deductions for tax purposes are limited to your mortgage interest up to $750,000 of qualified indebtedness, thanks to the Tax Cut and Jobs Act. So any loan that was issued after, for easy purposes, 2017, if you went out and got $1 million loan to buy your principal residence, you would only be able to deduct the interest on $750,000 worth of that. There's grandfather debt, which means that if you had $1 million loan prior to 2018 and that is still in effect, you're not limited because it's grandfather debt. But the new law for all individuals is that you're limited to $750,000 of mortgage interest indebtedness that you can deduct interest on. You can also deduct your real estate taxes on your principal residence, but all of those deductions that relate to your principal residence go into a bucket called itemized deductions. If those itemized deductions are not above the standard deduction, you're going to take the standard deduction because it's bare minimum. Lower, you would take the top. So not even go into more than that, but your real estate taxes on your property, in addition to your state taxes on your wages, are all limited to $10,000 under the Tax Cuts and Jobs. So if you have $6,000 of real estate taxes on your principal residence plus $6,000 of withholdings on your W-2 wages, you would have a total of 12, but you're only going to get to deduct a max of 10,000 currently. So you get 10,000 there, plus your mortgage interest, plus your charitable, plus any medical expenses. Real estate as a rental property is is generally the same as far as deductions, but the interest side of it, same, you can still deduct that, real estate taxes, and any other operating expenses to maintain that property for rent. And that is a very open-ended a bucket there, but more than happy to entertain questions on what you can and cannot deduct.
With
Hold me liable for it.
yes, exactly. No, we're just friends talking. You're not getting paid for this advice. It doesn't count, right? With home equity lines of credit, I remember actually we were buying our home when we were our current home, Nicole, when we were figuring out when we were right around that 750, is it going to be 750? What is it going to be? And figuring out exactly what we needed our primary loan to be. And we ended up doing a 2 loan just in case. And then we couldn't write off the HELOC anymore because we did a primary plus HELOC. So the HELOC on a primary, HELOC is a home equity line of credit, is no longer, is that correct? You can no longer write off that, deduct that interest, but you can when it's on a rental property. Is that correct, Mike?
That is correct on the rental property. On the primary residence, if it was used to buy, construct, or significantly improve or put an addition on, you can still deduct that interest as long as it's under the 750,000 total loan limit.
So
But
landscaping?
if you go take a HELOC out to pay for college, not deductible interest. But if you use take a HELOC out to put on a second bedroom or finish the basement, still deductible interest.
Okay. Anyone else have questions about specifics as far as what you can and cannot? Yeah, I mean, you can really get pretty liberal with your rental properties, has been my experience, to be able to write off, quite a bit of things depending upon who's renting it and how the program is working.
Yeah.
Cool. Any other questions for Mike? Otherwise, we're going to keep you on, Mike, but switch over to Nicole to talk a little bit about what our loan options look like when it comes to a investment property or a second home and how that looks.
So an investment property in a second home, if I could do them all as primary or second homes, I would. You should definitely capitalize on that strategy when looking at starting to expand your investment portfolio. Are you willing to move and then rent out the one that you just vacated? Are you looking at buying a mountain property that maybe you're going to rent out on Airbnb, so you buy it as a second home? Or is your first rental going to be out of state and your family? We could do that as a second home. There's some options that we would definitely want to talk about getting creative in your specific scenario. But to break down the loan specifics that you need to know, the difference is if I'm buying a primary home, I can put as little as 5% down if I'm a move-up buyer, or if I'm buying in a high balance loan limit, or I can put 3% down if I'm a first-time home buyer. If it's a second home, it's 10% down minimum. And then in some cases, it's 15% down, depending on Fannie versus Freddie. And investment properties, it's a minimum of 20% is what I'll tell you. The guidelines will actually say that the minimum is 15% down, but that comes with a higher interest rate, and mortgage insurance starts to strip out the cash flow opportunity on an investment property. So personally, from an investor, I would put a minimum of 20% down to stay out of the mortgage insurance realm when buying an investment property. Unless you were buying a 2, 3, or 4 unit, a duplex, a triplex, a quad, then you'd need to put 25% down. So that's the down section of it. There's some opportunities. If you're looking at purchasing an investment property, not only do you get the tax benefits that Mike was talking about and the 1031 exchange benefits, plus or minus some changes coming down the pike, I'll tell you that presidents change and so do tax laws. So as long as you continue to hold that property, depending on when you need to exercise the exit strategy, it might work in your favor again. I'm a long-term investor, so I don't plan on selling my investments during this administration. And I hope that those tax laws change again before I go toes up. So we'll see how that works out for me. But for right now, when looking at the tax advantages, I would say one of the things that I know Mike probably does for a lot of his clients is capitalize on that Schedule E form. Lindsay was asking about, well, how much can I deduct, as a primary home, investment property? That Schedule E is a gold mine for an investor. If I can take those gross rents and start deducting all the maintenance and the management and the expenses and get it down to where it's only a smaller net rent that I'm taxed on, that's a huge benefit, especially when you get a little bit older in life and your investment income is your only income. So you can really strategize with your CPA, with Mike, in making sure that you're optimizing all of your opportunities. But to get back, so if you're buying that investment property, one of the cool things that we look at is your income that qualifies you for the investment. We can use the rental income from the property you're buying. And I get this question all the time. You're like, but I don't own it yet. I don't have any rents on it, or I can't have a lease on it. Well, the cool thing is it's based on the market rent. So I can have an appraiser to tell me what that market rent is. I can use 75% of it, and I can use that as income towards my overall debt to income ratio, which allows me to qualify for more. A lot of clients will ask me, well, how much can I buy as an investment? Can I buy a $300,000 investment, a $400,000 investment? And so I'll tell them, as long as their current personal debts are covered by their current personal income, then the investment takes care of itself. So on this side, if I know your debt to income ratio is all in a line and you're healthy financially, then on the investment side, as long as I'm purchasing something that at 75% of the market rents, and I'll give you an example, say the mortgage on that investment property is $1,500 a month. It'd be a small investment in this market, but the mortgage on that is $1,500 a month. And the rent on that is $2,000. Well, 75% of $2,000 is $1,500. So they wash each other out. I can buy a bunch of those, 10 to be exact, because Fannie and Freddie allow you to have 10, and then you have to switch over to a portfolio lender. So those are the kinds of things, that we're looking at. The differentiation on a second home, an investment property, some of you guys might have heard, we're talking about all these changes that are happening in the IRS and the 1031 exchange and the step up. Well, FHFA, which oversees Fannie Mae and Freddie Mac, loves to keep my job interesting. And they continue to make changes that, in my opinion, continue to contract what the home buyer can access as far as a loan goes. And their most recent change limited the number of loans that they buy, Fannie and Freddie, from lenders such as myself, because I work for Fairway Mortgage. They limit second homes and investments to 7% of their portfolio. So what does that mean to you? Because that's a bunch of numbers. Well, if I'm producing X number of loans every single month as a percentage of the larger scale, so say I'm producing 100 loans a month, I'm a small lender. Only 7% of those, or 7 loans, can be a second home or investment. The 93 have to be primary homes. And if I try to sell that 8th to Fannie Mae or Freddie Mac, they're going to say, I'm sorry, we're not buying. Well, that becomes a problem for lenders. And so lenders need a home for the loans that they originate. And so some lenders, which are smaller, are cutting off. I actually had a borrower contact me this morning saying, are you still doing investment properties? And I go, absolutely, because my lender isn't. My lender is above the 7%, and Fannie Mae and Freddie Mac said they won't buy anymore until we drop down. So that lender shut down any loans of investment in second homes. And Fairway Mortgage is so large that we have other buyers on the secondary market to buy those loans. But it sometimes can affect interest rates and access and some other things. So it really is important that if you're looking at investing this year or anytime in the very near future, that you partner with, a Mike to assess what is the tax ramifications and the positive and the negatives and things that you need to avoid or steer towards, and a lender and a realtor like Lindsay and her team, who are going to help you kind of assess that best case scenario, which I know Lisa is going to talk about in a second. But the knowing the loans and the restrictions on the loans and your availability to access, maybe you're willing to move and you buy that next home and you rent out the rooms and you do house hacking before you move into the next one. So capitalizing on primary home rates and down payments help you kind of elevate and increase your portfolio at a faster pace. One of the things that you asked me is how I feel that I've benefited from the tax advantages of the investment properties. I know that I kind of explained a little bit of this, but I do want to also say that too, especially as lenders, as real estate professionals, you have the ability to have businesses that are classified differently so that you can write off a lot of these expenses. So really going back to, and I'm not a CPA, and I don't pretend to be one on TV, even in a square box. I pass that off to Mike, and you might even want to jump in here about the opportunities that investors do have in this time in the tax code.
I think, well, can I actually ask you a real quick question?
Please.
So when in a rental property situation and you have a customer that is putting a rental property in an LLC for legal protection,
Yes.
will you lend to an LLC, a single member disregarded entity for investment properties, or are you still going to put the primary individuals on that mortgage?
So Fannie Mae and Freddie Mac, and I'm a Fannie Mae Freddie Mac lender, right? So I do government, FHA, VA, USDA, and jumbo, but I don't do portfolio. So that's where I'm going to quarter off. I don't loan in an LLC, but portfolio lenders do. I don't loan in an LLC. You have to personally guarantee the loans that I do. However, Fannie Mae has written in their guidelines that as long as the majority ownership of the LLC is the people who are guaranteed on the loan, you can convert that loan. So I can take that loan and say I want to do a refinance from an LLC. I can quit claim it back into the individuals. I can do the refinance, and then immediately after the closing, I can quit claim it back into the LLC.
Good. Thank you.
You bet. But you want to make sure that the lender knows to do that Fannie Mae, because Freddie Mac does not allow that.
Yeah, that's good info. Thank you.
That was worth coming tonight right there. So anything else that, Mike, that based on what I was just saying that you wanted to add as far as the benefits on that Schedule E or other tax benefits?
If to touch on it briefly, all of your rental expenses, your net rental loss, which would be your gross rents received, less your mortgage interest, less your real estate taxes, repairs, supplies, maybe some mileage, there's depreciation in there. Gross rents minus all those deductions gets you into a net taxable rental income or loss. You can deduct rental losses up to $25,000 if you are actively participating in that rental real estate activity. If you make over $150,000, those losses are suspended and they carry forward to offset future rental income or rental income from other passive activities. That's gonna get real accounting technical there, but generally, if you can make under 150,000 adjusted gross income, you can deduct rental losses against your ordinary income, your other W-2 wages, your interest income, any other income you can deduct. If you make over that, all that is a piggy bank to offset gains if you eventually sell the property in the taxable scenario, or have it's eventually going to turn into a net taxable situation because you're going to lose depreciation over the life of the property. For the most part, if you're cash flowing on a rental basis, just straight cash flow, rents received less expenses paid, and you're not having to recognize any taxable income for that due to suspended losses carried forward, you're in the money, you're in the red, you're looking good. So
And the one thing though and I would add too, is especially if you're looking to purchase additional rental properties, say you're in the acquisition phase, right? Because we all kind of know where we're at in life. Are we still acquiring as fast as we can? Are we level setting with the properties that we have? Or are we starting to divest those investment properties and really wanting to take advantage of the 1031 and the step up in value, because that's the stage of life we're in. So while you're acquiring, you want to make sure that you're keeping your debts low. Like that would not be the time you'd go get a Tesla lease. I'm just saying, you'd want to wait until after your acquisition phase. You want to be strategic about the debts you're willing to take on. Getting high credit card balances, student loans, purchasing that beautiful home that you've been wanting might come after you purchase a couple of rental properties. So all of this is strategy. And then the write-offs that Mike is talking about, I love that you can like write this off. And I've told like friends, like that lawnmower that you need for your house, you're bouncing back and forth, the printer, anyway, I'm talking to my CPA about stuff like that. So, but all of that you want to run by your lender and say, hey, here's the draft of my tax returns. Am I in a position to continue buying properties this next year or the second year? Because we look back 2 years of tax returns. Is this going to affect my ability to keep buying? And if not, I might or might not want to adjust some of my expenses. I'm not telling you to make up income, but you might or might not want to adjust some of your expenses based on your desire to continue to acquire properties. So that's, again, the partnership between the real estate agent, the lender, and you as the investor, really making sure that you're capitalizing on everything Mike will let you write off while still not writing off all of it so that you can purchase the next one. So
Yeah,
Lindsay, I'll bounce that back to you.
It's a balance. It always is, right? As long, what the rental properties also as a 1099 or a business owner, you got to be careful how much you write off. So it doesn't, come back to bite you in the booty. Nicole, can you talk about how many vacation second homes that one can own finance and the requirements for it to be a second home or a vacation?
Yeah, so you can own as many as you want. But if you want to, I want to own a lot. No, you can, but if you want to get a Fannie Mae or Freddie Mac loan, you're limited to 10. Now, if you're buying your primary home, you can keep buying a primary home. So if you're that house hacker that's willing to move like 20 times, and it could happen, then you could move 20 times. As long as you keep buying the primary home, there's no limit on the number of finance properties that you can own and still get a Fannie Mae or Freddie Mac loan, other than the fact that you need your debt to income ratio and everything else will come into effect. I'm not going to go down that road. But if you're buying an investment property or second home, then you're going to be subject to 10 financed properties. So if you're trying to buy that 11th, you've got a couple of options. When I'm working with investors and they're that far into it, they might have a property that's ready to be paid off. They might refinance one property and pay off 2 or 3. They can go to a commercial bank and they can blanket loan a handful of them so that they can purchase with Fannie Mae and Freddie Mac. And the desire with Fannie Mae and Freddie Mac, as I'm talking about, you're like, why do I care? Which would be a great question. The reason you care is because conventional financing allows you to do a 30-year fixed loan at a low interest rate. 30-year fixed is nice because I can flatten my expenses, right? I know what they're going to be for the next 30 years. I can also make them smaller compared to, say, a 15-year fixed, because that 30-year fixed is on my credit report. I have to calculate that in my debt to income ratio. The 15-year would spike up my debts. The 30-year, I can pay like a 15, but it's the 30-year payment that's affecting my ability to purchase the next property. And the second home theoretically has to be 100 miles away. That's not a hard and fast, it's more of an FHA rule. But second homes are going to be looking at, is it far enough away that I would travel there for the weekends, like a mountain property, a lake property, maybe a downtown condo, and my primary home is down in Highlands Ranch. It has to make sense that it is more of a vacation home, an entertainment home, a weekend retreat. Maybe it's out of state. If you're going to buy your first investment out of state, do that as a second home. Maybe there's family close by. Any number of reasons I can think of why that might be a second home. But that's going to get you a better interest rate and less money down if you can, but you're still going to be limited to those numbers.
That actually brings up one point too, is that on the personal tax deduction standpoint, you can deduct the mortgage interest on your principal residence and one other home, technically.
Because you can have multiple second homes.
Right.
You can absolutely, we've had clients have 3, 4, 5 multiple second homes.
Mhm.
Mhm.
So if that second home is actually, you're also Airbnb-ing it. Let's say it's a mountain home. You buy a second home here, you're Airbnb-ing it. You would already still be able to deduct it, right?
As a rental.
As a rental anyways. Okay. So
And
it's
can-
more so if you're like in 2 different states and you really aren't Airbnb-ing it or whatever.
Right, right. Mhm. And
I've
that's
tried to make things be a second home.
a motor home, a boat, if it's got a toilet, all types of places.
I mean, I think this is like the biggest advertisement ever for how much of a team you need when you decide to build wealth through real estate. Like, just know you don't need to go at it on your own. You don't need to remember all of this because it's all so different. And having your team together so that you know you're asking the right questions and that you have an expert weighing in on it is really the key to all of it. It's a lot of creative thinking. I think, you know, we talk about this every class where we teach about investing, Nicole, but the ability to buy a duplex or a triplex or a quad and live in one unit is probably the best place to start if you have the option. And then I call it the leapfrog method, where you are willing to move, which makes it really easy. And it allows you to appreciate and kind of see that cash flow pretty quickly as you move out of it. And we've had some luck with that. But it's always weighing it out and really figuring out, you know, what your goals are. I have one more question for Mike, and then I want to talk to Lisa a little bit about strategy and opportunities. Hey, Mike, if someone's buying we just had this and I referred him to you, where their second home is here in Colorado, and then they have to hold the 2%. Can you speak to that a little bit in case we have clients looking to buy second homes that we're helping?
Yep. So if you are a non-resident of Colorado and you sell real property that is located in Colorado, you are subject to a 2% withholding on the sales price if you cannot show that the gain is excludable for federal income tax under the primary residence gain exclusion, that there is no gain on the property, and that your net proceeds are less than the withholding amount. What that means is that if I own a house, if I live in Utah and I have a second home here because I like to ski with my family in Vail, if I sell that home, I have to, they're going to withhold 2% of the sales price on that transaction unless that I can prove that there's no gain, because it is not a gain that's excludable for my primary residence, and I'm not a Colorado resident. So the only way to get out of that is if you can prove residency in Colorado, or that there's no taxable gain on the property that Colorado would get income taxes on.
And again, you definitely have them call their accountant or set them up with an accountant, because it can be tricky.
It's a huge surprise to most when they have
Yeah.
hold 2% of that sales price for up to you. If you sold that property in January, they'll withhold the tax and you'll have to file a Colorado tax return to get that money back. But that could be a year, that could be actually over a year technically before you get that money back. So that's a consideration for investors, investors.
They don't pay you interest on that.
Mhm.
Like they
No,
charge,
sure
right? Is that applicable in states that do not have state income taxes? Gabe asked. Nope. It's only specific to Colorado. Every state would have their own rule. Is that correct?
That is correct. But the general theory behind it is that Colorado wants their portion of tax on the property that was sold in their state. So if you're an out-of-state resident and you sell a property, they want to make sure that they can get their share of the pie before you dip out and not file a tax return. That's the point of it.
Cool. One more question from Gabe before we talk with Lisa about strategies. The mortgage interest on a primary home plus vacation home are both deductible on my Schedule A up to $750, correct? Or could they each be up to $750 for the mortgage?
Well, depending on how many days you rent that vacation home depends on that answer. Because if you're showing that vacation home, well, is that vacation home no rental at all?
Correct.
So, yes, that's limited to $750 if the loan was taken out after 2017. The total of those.
Total. Okay. All right, Miss Lisa, I think we've partnered up. Nicole introduced us, and I have a passion for investing, but I've just been doing the leapfrog thing where it's like, well, I love this house, so I'll just keep it and rent it to the next. And it's worked out well for us. And then we've made some straight investments. But bringing Lisa on board has allowed us to really talk through what additional strategies look like and evaluating it and all of that. I would say that Denver is probably not the easiest market to be making successful investments in right now. However, there are options, right, Lisa?
Yeah, thanks guys. It's good to see everyone. It's so good to see Nicole on a webinar again. I missed you so much. I love this team. You guys, I can't reiterate enough how important it is to have a CPA in your corner that understands the real estate laws and taxes. I used to have a great CPA that did my family for years and years. And he was more of a tax prep than more of a tax strategist. So when you do get an investment property, 1, 2, 10, it doesn't matter. Definitely get somebody that understands tax strategy. I moved to a great CPA firm like Michael's this year and went from owing $4,000 on taxes in the previous year to getting $7,000, refund this year, all because my team knew what to do. I own 5 doors and it was about, hey, you got to deduct this. And I think Melissa asked a great question about, how much can you deduct, which is a really great question. And I didn't deduct enough last year. I bought my properties. I didn't do anything to them. They were great. And my CPA is like, no, you need to spend more. So, okay, new gutters. And, I started doing some capital improvements that then translated to a pretty significant write-off. So having a good team and people that are in your corner is super important. And then knowing what you don't know. We've touched on 1031s. We haven't touched on cost segregation yet, but that's another really cool tool. I don't know, Mike's nodding, like us total real estate tax nerds can geek out on cost seg, and we can go down that rabbit hole if anybody has specific questions, but just know what you don't know. And having a great team kind of help behind you is really great. Nicole is my personal lender as well, and I didn't know anything a few years ago when I started this investment game, and she is absolutely amazing. Lindsay as well, we've all kind of helped each other with our strategy. A lot of us did sort of fall into this game by accident, if you will, a term that is now, of course, coined house hacking that we've all been doing for years, because we just you bought a house in either somewhere between 2007 and 2012, when a lot of us kind of either came out of college or moved to Colorado. It was kind of a great time, and you were underwater. I kept my first house because I couldn't sell it. I didn't realize that was the smart strategy, and now I'm an investor and I pretend I meant to do it. No, I just couldn't sell it at the time. So it doesn't really matter where you're at in that journey, whether you're just getting started, if you're young, if you're older, if you have a lot of property or no property. We definitely want to sit down and talk to you and figure out what is the best strategy for you. Everybody's different. There are so many tools in the toolbox to use to get from A to B, B to C, all the way to Z. And that goal, that end goal, is different for everybody, right? We talk about financial freedom. What does that mean? Is it money in the bank? Is it an X number of properties? Is it time? Is it being able to retire? For me personally, I reset my clock a couple of years ago out of a nasty divorce. I had a bunch of debt. So I found myself at 40, basically broke, starting over. And I knew from my family and my experience in real estate, it's by far the best way to move the needle on wealth. Not money. You can make 6, 7 figures. You can buy whatever Robinhood stock or Bitcoin or Dogcoin or whatever kind of cool thing is out there in the moment. That is not wealth. Okay, long-term wealth is in real estate. It's the cheesy as it sounds. It's the American dream. All these loopholes, tax and 1031 and all the stuff we're talking about exists so that you can create wealth through real estate. Okay, Warren Buffett said it best. He's made so much money in all kinds of different businesses. And he said, anybody who has money either makes it or puts it in real estate. And you can't argue with the Buffett, come on. So I'm here to pull it all in. We can talk strategy, love to ask. specific questions. We have an expert on cost seg. That's amazing. I
know.
mean, that is like the holy grail of basically capturing all of your depreciation up front in year one. It translates to a pretty hefty refund, like a check that you then get to go and buy more real estate. There are a lot of caveats, like you have to be a real estate professional technically and spend, 75 hours a week, which if you own a handful of rentals, that's pretty easy to do. So yeah, I want to definitely sit down with you guys, talk about your strategy, your goals, and then help you get there. You have an amazing team behind you. We have an abundance of knowledge and experience on our team, and get you guys going.
Melissa says, what kind of professional helps you with cost segregation? Her name is Bonnie, Melissa.
A therapist.
This
This is wine in my teacup, by the way. We all need therapy.
We all know, Lisa. I know. I get it.
Oh, there is actually, so it's special CPA, Bonnie, is that what you do? A cost seg expert. Some banks will say they do it. There's different studies. There's an engineer study that is quite expensive. And then any CPA will do it in-house.
They're not all the same. And unless a CPA is an expert also in construction and engineering, they don't do the IRS's preferred methodology, which is engineering based. I represent one of the largest, well, it is the largest cost segregation company in the United States, and we're in all 50 states. We actually worked with the IRS to set the protocol for cost segregation back in 1997 when the court case came up that allowed cost segregation. So, you know, I'm here to answer questions, help anyone else or, you know, anything on cost segregation. It's not just for tax, it's not just for real estate professionals. It can also be for, you know, anyone with a property that's purchased at $200,000 or up to $2 billion.
You say that that's the break-even point on a cost seg is 200,000 of property value or cost value?
It's usually not worth doing a cost segregation study on a property less than 200,000. And that's because a lot of the things that on a property that's smaller than 200,000, your CPA can take some depreciation for you. You don't have to be an engineer to do a small property like that. Usually you can have your CPA do some, you know, accelerated depreciation on that, but they don't get everything that an engineering firm does.
Bonnie did mine. She's great. And if you're going to do it, spend the money and have the engineers do it, because then the government can't throw it out.
And I might also say that, you know, the company that I represent also gives you defense, IRS audit defense for as long as you own the property plus 6 years, or not just, I'm sorry, it's 27.5 or 39 years plus 6 years, which is the term that the IRS has to be able to audit you, even if you've sold the property. And most people don't know that.
27.5 years is the residential real estate depreciation life, and the 39 years a commercial property depreciation life.
Commercial and short-term rental property.
Sure.
Thank you, Bonnie. We'll send your contact information out for sure and add it to our resources.
Yeah, I would like to.
Thank you.
For sure. Yeah, we'll get it to you, Mike. I think, you know, like what Lisa was saying and Nicole talks about a lot is real estate is a very secure investment. So even if you do the analysis and it's not going to cash flow for you perfectly right now, but you're looking to buy it and hold it, and you don't necessarily need the mailbox money right now, this is more thinking about retirement. Don't second guess yourself. Trust your gut. Real estate is a solid investment. It is your ability to fix your investment on an asset that's going to continue to grow, right? And you can lock in at least, you know, obviously insurance and taxes can change, but at least you can lock in your principal and interest right now. And that is where the huge opportunity is. And then, yeah, if for some reason you think you're at the lowest you could possibly go on rates, don't worry, you can refinance it later and get those lower rates. But I think that ultimately, you know, I really do, thank you, Gabe, for hopping on. I really do believe in it. And I believe that real estate is the best, if not only way for the working American to build long-term wealth. And that is kind of what the basis of Live.Laugh.Denver as a brokerage was built on. I stumbled my dumb 20-something booty into a condo that I also couldn't sell when I put it on the market for 2 weeks because it turned out the universe didn't want me to. And I said, never mind, let's not sell it. Let's just buy the next place. And fast forward, we actually leveraged the equity from that to buy the office I'm sitting in now. So once you get pieces of the pie, Monopoly is way more fun. It's getting started. And so I always tell people, do not worry. It will not be perfect. No home you ever own will be. That's the good news. Just get started so that we can start building this for sure. Melissa, we love you. You're the best. Lisa's going to end us off on a note about how real estate is the hedge against inflation, which is very true. Hit it, girl.
Yeah, I mean, basically, if you have money in the bank, the actual definition of inflation is to devalue that value of a dollar. And we have to do that, as you guys have seen now, we're at what, over 3% instead of the annual 2%, to devalue our debt. We just took on trillions of debt, and it's not going to stop with this administration. And so if you're sitting on money, if you're sitting on equity, use it, put it in real estate, put it into an asset that is fixed. You have a fixed payment for 30 years. Well, inflation goes up, rents go up, your payment stays the same. And rents are on the rise. We're at 1.6%. That's the first positive rent increase we've seen in Denver in 6 years. It's amazing. I mean, we can talk about how forbearance and oh my God, I can go forever. I know you're going to cut me off because it's 6:30, but I love this stuff. Can we please go? Let's go get coffee, drinks, and talk how to create wealth through real estate.
This is the first time we've covered taxes on our Live, Laugh, Empower series, and it is such an important tool when it comes to building wealth, and especially when we see the billionaires avoiding taxes through tax loops. I mean, the least we can do is be smart with our investments, right? I mean, we got to at least maximize our deductions and our strategy and minimize our liabilities there. So Mike, Nicole, Lisa, and Steve for hopping on earlier. I cannot thank you guys enough for your time. We will be sending and sharing your information out and as well as referring them to the team or to our clients, the whole team will. We really appreciate you, but most of all, for our tax professionals, take a break. I'm sorry. I'm sorry that we are the worst. All of us are the worst. But yes, thank you so much. And we'll be in touch. I appreciate this, you guys. It was a great combo.
Thanks all. Thanks for having me.
Yes, thank you.
Bye-bye.
Bye.